Warm welcome to you all. I hope you all are able to hear me. If anyone can just type yes in the chat and confirm. Yes, thank you so much for the confirmation. So I welcome you all and thank you so much for taking some time off from your schedules and joining us. Let me begin straight away. I'm so sorry, there is a slight technical glitch, so I'll need a confirmation once again. If you can just confirm if you all are able to see my screen. Thank you so much. Thanks a lot. So I welcome again. I know a couple of our friends are fasting today because of Ramadan, and I especially thank them to have taken time and joining us. And I welcome you all. And it's good to notice that we have a mixed audience here, a good amount of number from UAE, as well as good amount of number of people from India as well. So good evening to you, and I welcome you all. So in today's session, I'll be speaking on spotting opportunities in gold trading and how we can leverage instruments like CFD, that is contract for trading, to leverage such profit-making opportunities while we trade the commodities. Just a brief introduction of myself. I'm Milan Vaishnav. I am founder of ChartWizard, FZE in the UAE, and Gemstone Equity Research and Advisory Services in India. I am a CMT charter holder as well as MSTA holder, and we produce technical research, independent technical research on Indian capital markets through Gemstone Equity Research. And through the ChartWizard FZE, we produce technical research which covers UK and US equities as well as international commodities like gold, crude, and also the cryptocurrencies. Gold and crude are, as we all know, are in obvious focus because of the ongoing geopolitical tension between UK and between Ukraine and Russia. But this commodity has traditionally offered us a very good and steady trading opportunities, on which we will talk about this as we move ahead in the session. Apart from this, I have been a regular contributor to the Economic Times here in India and a featured commentator on StockCharts.com. I have also been a very active a contributor in our CMT Association's monthly newsletter and have opportunity to have contributed in the other financial media as well. So I'll be your host for today, and I would encourage all of you to sit through the session, which I believe will be. I'll try to make it very interesting and rewarding for you at the end of the day. And I would encourage all of you to have questions, which I will take to the extent possible once we are all done with the session. In the end, we will also be joined by our partner broker, Amana Capital, through Mr. Taher Al Khatib. And at the end of the session, we'll have something for you all. You can take it as a takeaway from us. So there's the regular disclaimer. So in this session, before we move on to the to gold and try and spot opportunities in gold and take a broad directional view on gold, we will be first focusing on the instrument which we will use to leverage and explore these trading opportunities. So it will be CFDs that we need to understand. I'm sure many of you must be regular traders, but many of you may be very new to this platform. So let me focus on what CFDs are. So in this session, we will focus what are CFDs, and we'll try and understand this instrument better. CFDs, by the way, are contract for differences. It's just like it's a financial contract, just like we have futures. We have CFDs as well. We'll also try and know how CFDs are different from shares. What makes CFDs attractive? Interestingly, but most people lose money while trading CFDs. We'll try and explore the reasons behind this, and we'll also try and find out ways how we can mitigate these things and make CFDs work for us in a favorable way. We'll ponder over how to make most of CFDs and trade them profitably. We'll take a technical look at gold. We'll look at the possible directional move in gold from the long term, medium term, and short term perspective. We'll explore the factors which is making this precious metal to shine, and we'll also take a look at the important levels that we need to look at going ahead over the coming quarters. And we'll also try and focus on the directional bias that the gold is expected to take, and we'll also discuss the key levels that we need to keep in mind while we approach trading the gold from the different time zone perspective, whether we are dealing with short-term perspective or medium-term or short-term. We'll try and focus on the directional view that we will take. And we'll focus on the final takeaway at the end of the session. So what are CFDs? CFDs basically stand for contract for differences. They are just like futures contract, they are derived from the underlying. In this case, underlying is gold. When we say gold CFDs, they are derived from the asset underlying, that is gold, and it tracks the prices of the gold exactly the way a future contract tracks the prices of the gold. Unlike futures, in futures, what we have is that unlike futures, this is a contract between the seller or buyer of the CFDs and the broker, that is a liquidity provider or the platform that that provides the facility to trade CFDs. So if this sounds a little complex, but if I try and make it simple, whenever there is a future contract transaction, there is a buyer and seller of the contract. So when someone buys a future contract, there is actually a seller of the future contract. But in this case, what happens that when someone buys a CFD contract, there is no actual seller, but the liquidity provider or the platform acts as a counterparty. So we don't need to worry about this. It's a bit complex, but it's the platform that acts as a counterparty, and this differentiates the core, the difference between the CFDs and futures. The idea of the entire exercise is to benefit and profit from the movement in prices. As I just said, that it tracks the underlying assets, so the price of gold CFD also moves in tandem with the price of the spot gold. So if the prices of gold are moving higher, obviously just like futures contracts, the CFD gold prices will also move higher. So what I'm trying to pinpoint here is that it basically tracks the underlying asset. if you are a buyer of the CFD, you will benefit if the price moves higher after the purchase. And similarly, if you are a seller of CFD, you will benefit if the price move lower after the sell. Just like futures, these are CFD. They provide the similar method to trade. Now, unlike futures, when they are settled, they are non-cash settled. So when they're not settled in cash, you have to actually take or give the delivery of the commodity or the shares that you are trading in. But CFDs are settled in cash. So generally, the terms of the contract track the underlying. When it comes to the commodities, when it comes to shares, most of the times they are perpetual in nature. So let's keep our focus only on the commodities. The futures of the commodities are generally settled by actually giving or taking the delivery of the commodity. But CFDs are settled in cash. So once the CFD expires along with the cycle of the future contract, it is the buying or selling difference is settled in cash. So how they differ from share? It's the most common question that I keep getting, that okay, CFDs are available in many instruments. You have CFDs for the commodities. Just we have futures for commodities. We have futures for shares, and we have got futures for all the other type of commodities. We also have got CFD instruments for that. So how do they differ from shares? The biggest difference is that unlike shares, you do not own the CFD. You trade the asset without the ownership of the underlying asset. Let me make it simple once again. Let's say you buy shares of Google or Amazon or Facebook, or say if you are in India, you buy a Dabur or ITC or Reliance or anything. You actually own that share. You own that asset. You have those shares either with your in your custodian's account, or you have it in your demat account if you are here in India. But just like futures, when you are trading CFDs, you do not own the CFDs. You just track the movement in the prices, benefit or lose, or make profit or make losses out of those moves. But you do not own the underlying asset. It's the key difference when CFDs are compared to shares. So when you trade shares, you take the ownership of the underlying asset, as I just said, the share itself. But that's not the case with CFDs. Another key difference is that trading in CFDs will offer you leverage, while trading in shares will not offer you any leverage. Normally, if you are having $10,000 in your account, you will be able to buy shares worth only up to the money that you have in your account. In this case, $10,000. Whereas when you are out buying CFDs, you will not buy, but you will definitely get leverage. You will be able to buy multiple times of the capital available with you. So CFDs will offer you the leverage, shares will not. Generally, going short is not an option in shares. Now, if you have a bearish view on gold, or if you have a bearish view on shares, for example, if you feel that the price of the Twitter share or Amazon share or Reliance will go down, so you intend to go short. If you are holding if you're not holding shares in shares, I mean, generally speaking, going short is not an option. But like futures, if you are trading CFDs, you can benefit from the declining prices, wherein going short is an available option here. CFDs will reflect actual splits and divisions, etc. So this relates to the share CFDs, not the commodity CFDs. So if you are holding a CFD for, say, Apple shares, and if Apple declares any dividend, you will get that adjustment in the quantity of CFDs that you are holding. Now, another difference between contract for differences, that is CFDs, and shares is that shares are traded only during the exchange trading hours. Most of the cash exchanges trade for 6 to 7 hours, 5 hours a day, whereas CFDs can be traded round the clock. most of the contract for difference is trade for 22 to 23 hours. So practically round the clock trading is possible. So going on, the idea behind the entire trading of gold and using the CFDs as a medium is that we all want to benefit from the movement in price. So in older times, how would you trade? It's not practically possible to trade in physical commodities. So for example, if you're interested in doing a short-term trade in gold, it is not possible for you to go to a souk or a marketplace and buy a physical gold in some quantity and then wait for the prices to move and go back again in the market to sell it back in the physical form. It doesn't happen that way. You will have you will face practically all sorts of difficulty in actually buying it, actually selling it, and in between that time you will have difficulty in maintaining the custody of the asset when it is in physical form. So the entire idea or the concept of trading CFD is born out of the idea that we all want to take the benefit of the short-term price movements, and therefore CFD being an electronic financial instrument, we can do this in a much simpler and easy way. Now, just like all other things in the world, CFDs will also have a couple of advantages and couple of disadvantages. So let's focus on the advantages first and what makes trading in CFDs attractive. The most attractive for any trader or an investor is the leverage that CFDs offer, and this is often the biggest advantage. Unlike shares, very painful, you can invest in the corresponding CFDs at a fraction of your cost, or just by paying a margin. Now, let me illustrate this with an example, actual example in gold. If you are buying 100 ounce of gold, you may be required to pay 1,80,000 US dollars at the price of 1800. Let's take the price of gold at 1900 approximately. And if there is no leverage, and if you actually want to buy 100 ounce of gold, you will be paying worth one future contract. If you want to buy gold, you will be actually paying 190,000 US dollars. So in the same way, if you just want to buy a troy ounce of gold and the price is 1900, you will be required to pay entire 1900 rupees and $1900 in full to buy that quantity of gold if there is no leverage. But now when it comes to trading CFDs, you do get a leverage of multiple times, 5 times, 10 times. There are brokers who give leverage of around say 40 times and 50 times. So what I'm trying to say is that just by paying 5 or 10% of the required money, you can take that much amount, that much quantity, or that much size of the position in form of CFD. So trading in CFD offers leverage, unlike shares where you have to pay in full. Another advantage is single platform. Mostly across all platforms, across all brokers, across all service providers, most of the CFDs on all the asset classes, whether it is gold, whether it is oil, whether it is crypto, whether it is shares, they are usually accessible through one single trading platform. Whereas if you these instruments are from say various countries, you will find Indian Nifty CFD or American shares or European shares or gold or oil or crypto, all converged into one single platform. You don't have to go to different platforms to buy them. So this is also one of the single biggest advantage. I mean, it's the availability of single platform. Another thing, as I just said, that going short is not an option when it comes to shares, but shorting is easy when it comes to CFD. So if you have a bearish view on any share, any commodity, it's very easy to go out and go short on CFD. There is no need to follow any shorting rules of the exchanges. You don't need to own that asset or own that CFD before you go short, and there is no need to go to the complexity of borrowing or lending of those instruments before you short them. So shorting is made easy with CFDs. Execution costs are very less when it comes to transacting the CFDs as compared to shares, because many brokers provide a commission-free trading. There's no need to day trade. You can easily carry positions without any costs. CFDs offers varied and wide choice of asset class. As I just mentioned before a couple of minutes, that CFDs are available in multiple asset classes like shares, gold, oil, or cryptocurrency, or even global indexes. You will find CFDs for Nifty 50. You will find CFDs for NASDAQ, 100, for Dow Jones, for German DAX, FTSE 100, and so on. So, having now seen a couple of advantages, as I just said, everything has some disadvantages also, and so does CFDs. Now, now let us have a look on a few of the disadvantages that can work against us when we are out trading the CFDs. We read these things a lot on CFD brokers' website. In fact, it is required from the regulatory standpoint that CFD platform providers have to declare and have to make known to the public at large that CFDs are complex instruments. There is a high risk of losing money because there is a lot more leverage that is offered to the clients, and clients do end up taking that much of leverage. You also read things like trading CFDs and Forex may expose you to significant losses. And you will also come to know about certain statistics like say for over 68% of people trading CFDs lose money on this platform. So from the regulatory standpoint, this is required, so brokers disclose this. But for an average trader or an investor, this really sounds scary. Does it? I believe most of you will answer in yes, in affirmative. Yes, obviously yes. This certainly sounds scary because none of us like losing our money. You know? But the answer is both yes and no. It is scary, yes, but no if you manage your risks following some very basic rules. So what are the disadvantages? Why do people lose money trading CFDs? If we are able to focus on these things, and if we are able to take care of these things, you can literally take for granted that CFDs are very good trading instruments and very good means to making profits while benefiting from the price movement of the underlying assets that we are trying to trade in. It's a spread. One of the disadvantages is spread. Now a trader pays a spread on each entry and exit. This reduces the profit to some extent and widens the loss if the position is loss making. So what is a spread? A spread is a difference between the best buy and best ask. Now let's say, for example, again I will go back to the gold because it is gold that we are going to discuss going ahead. Let's say the best bid is for $1,900 for a troy ounce, for 100 troy ounce or one future lot or one CFD lot. The best bid is $1,900 and the best ask is say $1,910. So the difference of $10 is a spread, and this will remain on both the side as and when the price moves. So what happens? Let's presume you are out buying one contract. So when the price is 1900, you will buy it at 1910, and that spread is your cost. You will start your trade with minus $10. So if you are earning if you are earning $100 of profit into it, that $10 would be a cost, and you will make a $90 of profit. But if the trade goes on the loss-making side, it will increment your losses to the extent of the spread. So if you're losing 100 rupees on this $100 on this trade, you'll be losing $100 plus the spread of $10 on this trade. So it's a spread acts as a major disadvantage if you get caught on the wrong side of the trade, if you get caught on the wrong direction of the trade. High leverage, as I just said, CFD trading allows trader to take high leverage, sometimes 20 times, 30 times, and even 40, 50 times. The Forex CFDs offer leverage of as high as 100 times. So leverage can act against us. Uncontrolled leverage will have its own pitfalls. Now let me explain you with an example of 20 times leverage. For example, a broker or a platform gives you 20 times leverage. So 20 times leverage means if you have a capital of say $100, you will be able to buy or sell a position worth $2,000, 20 times more. So in other words, all you need is just 5% of margin. But many people fail to think that 5% loss would equal to 100% loss of capital. So uncontrolled leverage can destroy a trader, even an investor who is trying to be in the markets with a medium-term horizon. But uncontrolled leverage, whether you are a long-term investor or a short-term trader, can destroy you if you do not take it in the quantum required. If you go too much overboard on taking the leverage, the slightest move in the price can wipe out to your entire trading capital. Because as I just said, the way leverage can amplify gains, it can maximize loss as well. Let me go back to the prior example. If you are just paying a 5% margin and taking a 20 times leverage, if your trade gains 5%, you will literally double your money. So it has amplified your gains. I mean, just doubling your money is not a small task. It's not a small task. It is very good. But in the same way, a small 5% loss on the trade can wipe out your entire capital. So the way leverage can amplify gains, it can maximize losses as well. Relatively less regulated. Traders must rely heavily on the reputation and credibility and soundness of the broker. We have CFDs. The extent of the regulatory coverage is very much selective and limited to the regions in where they are allowed, unlike shares. So it is very important that the platform you choose or the broker you choose must have a solid reputation and credibility and financial soundness. So now, having explored all that, having known what CFDs are, and having known that they can act as a wonderful tool to exploit the movement in the prices of the commodities or the shares or any other asset class for that matter, and having known or having looked at the advantages and disadvantages, the obvious question arises is that how do we make most trading the CFDs? The biggest tool that we can use to make CFDs work in our favor is that take control of the disadvantages. Plan your trade and trade your plan. It's easy as I speak it, but once you go out and execute things, you will notice that you will require an actual effort in doing this. So what do I mean by this? Our sole focus in trading profitably when it comes to trading the CFDs would be to take control of the disadvantages that we just discussed. And one of the biggest risk factor in trading CFDs is the leverage. Remember, as I just said, if you are taking 20 times leverage or paying just 5% margin, you will just need a 5% loss to wipe out your entire capital, right? So first of all, we must refrain from taking any excessive leverage. That is the first thing. Second thing, adequate capital. We have make sure that your account is sufficiently funded in a way that you do not take more than required leverage. Leverage is required when it comes to trading a future or trading a CFD. But how much leverage to take is a key thing. It's a key point. It's a key factor that keeps you or kicks you out of the trade. So having adequate capital is a must. So you have to make sure that you keep your account sufficiently funded in a way you do not take more than 4 to 5 times of leverage. This would mean that 100% loss of capital will occur only when you lose 20-25% on your trade, which is less likely if you have taken your trade with a good amount of research going into it. So losing 5% or going negative 5% on your trade, it's a quiet routine. even a 5% loss on the trade can kick you out of the entire thing, or can completely wipe out your capital. But if the position sizing is correct, if the leverage is just to the extent required, and if the account is adequately funded, you will be able to sit through on the position for a longer period and with a reasonable amount of stop loss put into it. So the key point is that avoid excessive leverage and keep your account adequately funded, and take leverage only to the extent required. Now, only to the extent required, it's highly, it's a very qualitative thing when I say that. So how do we make it in a quantitative way? Because adequately funded, how much is adequate funding? It may be different for me, it may be different for you. It's highly subjective. So if we try and quantify this, then we can say that it would be the most prudent balancing out approach would be to not use more than 60% of the available capital in creating the positions. So, for example, if you have US dollar 10,000 in your account, you'll be able to buy one lot of gold. So, on an average, a CFD, one lot of gold, which is equivalent to the one future lot of CFD, is of 100 troy ounces. And at, say, for example, at 1900 of price of gold, you will be able to buy one lot of gold because it hardly requires 5% margin. But will you buy it? The answer is no, because when out of $10,000, you will end up using almost 91% of your capital by paying 8,800 or anywhere between 8,800 to $9,200 as a margin, and which will just leave you with $700 or $800 of free cash. Now, when the price is 1,900, and it would not be a strange thing for the gold to move in $10-15 range, but that will kick you out of the trade. Why you got kicked out of the trade? Because you have taken excessive leverage here. So what should be the prudent thing? Not using more than 60% of your available capital. So $6,000, which is 60% of your capital available, will allow you to go for half a lot. So invest half of the money and preserve half of the cash. You will still see decent profit rolling in, because if you do this, what will happen that you will just be using 50 to 60% of the capital. You will still have almost 40% of your capital, so $4,000 to $4,500 in cash, and that will lose only if the gold will move $800 to $900 against your direction, which would not happen because a trade cannot go wrong in this magnitude. So in the first instance, you will be able to buy one lot, but if you are buying one lot, your chances of making loss due to excessive leverage and not even able to withstand a reasonable movement in the price of gold will kick you out of the trade. But if that is planned properly, if your leverage is planned properly, then using the 60% of the money and going in for half a lot. By the way, in CFDs, you can buy lots in fraction, which you cannot do in futures. You cannot buy half future lot, but you can buy half CFD lot. You can buy 0.1 CFD lot, 0.2. So if you just go for half CFD lot, you will be sitting on a very safe position, and you will have enough time to stay in the trade and make money. So trade and liquidity management is a key. It's the key to safe and profitable risk managed CFD trading. And mark my words, if you are able to successfully manage your trade and also the liquidity, this will form a very solid base for your long and profitable existence in CFD trading. So now section 2, we will move to gold. We have been discussing CFDs with reference to gold. So gold per se has traditionally remained a safe investment for each one of us. But there are many factors that affect and influence the gold prices. First, just like any other commodity, normal supply and demand will drive the prices of gold higher and lower. Apart from there, you will also we also have industrial demand that influences the price of gold. And usually, gold has industrial demand from industries like electronics, gems and jewelry, etc. Central bank reserves. demand also comes from central banks as well. They have reserves in gold along with the other paper currencies. Again, natural hedge against inflation. We all know it's a known fact that gold acts as a natural hedge against inflation. So whenever market participants see turbulence in the equity market or overall turbulence in general economic landscape, a natural demand for gold will also arise because people would like to move to safer assets. Simple investment demand. Simple demand may come from retail households. Demand may come from ETFs, exchange traded funds, who passively trade the gold prices. And this also sometimes a spate or a phase of strong buying from ETFs also tend to keep the gold prices firm, and vice versa. Sustained selling from an ETF will drive the prices down, even if there is no other change in factors that affect the gold prices. Of course, the value of the US dollar, value of US dollar and gold prices are inversely related. So all things remaining equal, stronger dollar would mean lower and controlled prices of gold and vice versa. Any weakness in dollar in general will drive the gold prices high. Safe haven. During all kind of turbulent times, people turn to gold. That's a simple reason that drives the demand round the year and across all economic cycles. So how do you spot profitable opportunities in gold? First of all, when you are trading gold, regardless of the time frame that you use, someone may be investing it for a longer term, someone may be actively investing. By active investment, I mean short to medium term investments, where you buy and hold for a couple of weeks and try and benefit from the trend. Or even if you are a short term trader or literally trading in gold on day-to-day basis, avoid using complex technical indicators. Keeping things simple will help. Now, coming to the time frame, do not take lesser than daily time frame if you are taking an investment view, because I've seen people scouting for medium to long term investment opportunities and looking at an intraday 30-minute or 1 hour chart, which doesn't make any sense. So even if you are a medium term investor, do not use the time frame less than the daily time frame. So there are different time frames, right? A daily time frame, weekly charts, daily charts, monthly charts, and below daily, which people use for short-term trading, are other time frame charts, which are hourly, half hourly, 4 hourly, whatever it is. But avoid using less than daily time frame charts if you are taking an investment view, and avoid lesser than 30 minutes time frame if you are trading gold. So if you are a trader of gold, and by trader I mean if you are buying a position or for just a swing trade or very short term move in the prices, it may last for a couple of hours or a couple of days. Our suggestion is that avoid using lesser than 30-minute time frame of chart if you are trading gold, and less than daily if you are taking an investment view. And resort to basic pattern analysis to determine support and resistances. Don't clutter your chart with 4, 5, 6, 7 indicators. There are lots of colors and different shapes and sizes. It will make your life difficult. So avoid using complex and multiple technical indicators and resort to basic pattern analysis to determine support and resistances. You will be able to do it if you read a bit on the methods of basic technical analysis, which helps you identify very basic support and very basic resistance levels to deal with. If you are trading, you will need to have a basic technical analysis based methods in place. You will not be able to make money trading gold, or for that matter any commodity, any asset class, if you do not apply the basic methods which are available in technical analysis. You may all have your own method to trade gold, but generally speaking, continuous trend following methods work good in this asset class. So far as now, what I'm talking about is something that we do while we trade gold. We make dynamic use of leading and lagging indicators like RSI and MSTA and parabolic SAR. So these are just the 3 basic indicators that we use to continuously follow the trend and the micro trends within those trends. just for general information, that RSI is the leading indicator. Leading indicator means the patterns and the signals and the breakouts or breakdown appear on these indicators before they actually appear on the price. So if you're following or if you're taking decisions based on the leading indicators, it is the price that follows the lead indicator. So something would, if something happens on RSI, certain kind of pattern development or a pattern breakout or a pattern breakdown, it would appear on RSI first, then it actually appears on the price. So if it appears on RSI, you can fairly watch out for that happening on the price. It will warn you in advance. So that's why it is called a leading indicator. And MSCD is again, it's a combination of a leading MSCD itself is a combination of momentum oscillator. Basically, it's an oscillator as well. It's also a momentum indicator because it is made up of two moving averages, exponential moving averages. And the third one is the parabolic SAR. It keeps following the trends, and it will signal you the moment the trend is reversed. Now, one thing I would like to make you know all that while we use these indicators, we use the default values. You can change the parameters or the values of these indicators, or the parameters or the input parameters of these indicators, subject as per your need, but generally it is advisable not to change the default levels. So let me also throw some light on the suggestive methods. Normally, you can consider buying when MSCD crosses above the signal line, or there is a parabolic SAR bias signal. So I'm not going deep into this thing because it will become a little boring technical session. But if you have little working knowledge with these indicators, you will be able to spot the buying opportunities, buying or selling opportunities. Simply a similar sell opportunity or signal to exit longs will come when there is a when MSCD crosses below the signal line, or RSI slips below 70 from an overbought zone. So what we do is that why do we use the lagging indicator to enter, and why do we use the leading indicator to make an exit? The answer to this is pretty simple. We use lagging indicator because lagging indicators, the signal appears on the lagging indicator after they appear on the price charts. So whenever there is a little bias signal on the price pattern formation, or as per any general pattern analysis, the lagging indicator will give such signal after some time. So when you are making an entry based on the lagging indicator, it will add a confirmation to your call. It will add a confirmation to your directional bias. It will lend more weight to your entry or exit point. And why to use leading indicator to exit? Because if you will use lagging indicator even to make an exit, then what will happen, that a bulk of the profits on either side, long or short side, will get eaten away because signals on both the sides would be lagging. So you will take a lagged entry and you will take a lagged exit also. But if you take a basis, if you make a lagging indicator a basis of your entry, you will lend some confirmation to the entry. But leading indicator must be used to exit, because the signal to exit will appear before on the leading indicator, much ahead of the price, and it will preserve the bulk of the profits. So it's a it's a very proved and valid and well validated method that regardless of the indicators that you use, try and make exits on the leading indicators. RSI is one of them, and parabolic SAR also acts as either leading or lagging as per the structure of the chart. So these are the reasons why we use the leading indicator to exit. As I just said, it protects maximum profits. Using lagging indicators to exit will not yield any good profit, regardless of the indicators that you are using. So now let us focus on something more concrete, something more quantitative, and something more interesting. So how will you be trading gold in coming days? So when someone asks you that what's the view on any particular asset class, any particular stock or anything, the answer would be different depending upon the time frame that you are looking at. So we'll begin with a long-term perspective. We'll begin with a long-term monthly chart. Now, monthly chart of the gold are extremely strong, very buoyant and very bullish. 1950 to 1990 is a major triple top resistance zone for gold, and any thrust or strong move above this zone will propel the prices higher. This is the triple top resistance. This was first tested between in around 2012. Second time in the beginning of 2020 during the COVID times, during the beginning of the COVID times, and the second one was just recently. So this triple top formation, it's more of a cup and saucer kind of a cup and handle kind of formation also, as told in the technical parlance, is generally a very strong and buoyant formation. We also notice that MACD here is on the verge of giving a positive or a positive crossover. It's in the verge of crossing above its signal line, which will give you a buy signal on a monthly chart. And if this formation, if it technically it resolves on the expected lines, then on a next 2 to 3 year time horizon, you can expect gold to touch 24 to 2500 $2500 per 100 troy ounce. So from the monthly long-term perspective, the chart is extremely buoyant. All we need is a strong move above 1950 to 1990 range, above that zone. Once it happens, you will also see this MACD indicator giving a buy signal, and that will make the level of 1950 to 1990 a very strong support, because resistance once taken out becomes a support. So look out for a strong move above 1990, and we'll see the gold getting re-rated in price terms. So the long-term perspective in gold remains extremely buoyant. Now let's take a medium-term view. Medium-term view, we use weekly time frame, and as you see that after testing the high just close to 2100 sometime in July August of 2021, the gold has retested those levels in early 2022, but it has again consolidated and is tracking the 10-week MA. So overall, some short-term consolidation may not be ruled out, but overall, so long as it is above 1850 levels, the overall trend in gold is up even from the medium-term perspective. From short-term perspective, well, we are headed into some consolidation, some move, and some gold may spend some time between 1900 and 1990 price levels for a couple of days or couple of weeks. But overall, it has major resistance around again 1990, because it's a long-term level that we looked at. And once it moves above that, we'll see the prices moving higher. So 1960 to 1985 zone, it needs to be watched for the short-term time horizon. We will see the commodity pricing oscillating between 1950 to 2000 for some time for immediate short term, and it will take some time before it moves higher and tests the original resistance levels of 2100. But that would be for a short-term trading perspective. So if you are a short-term trader, then you have to place or plan your trades keeping in view the possible movement of this the price within this zone. If you are a long-term investor, simply stay put, stay long. The structure of the gold is very strong from a longer-term chart point of view. From short-term, well, it is subject to some consolidation, some ups, some downs, but it remains largely in the uptrend. The only thing that we need to guard against in the short term is the rate hikes that FOMC will be bringing in. That will strengthen the US dollar, and it may make life little difficult for the gold. It will eventually rise, but it will not rise as swiftly as it should, just because the dollar might get stronger. So this is the only thing that we need to watch. So now I would now the platform. I just said that trading, when it comes to trading CFD, it's very important to choose the right platform, the right broker with sound financial soundness and great reputation. So we have our friend Mr. Tahir Al Khatib from Amana Capital. Uh, I'll just hand it over to him for a couple of minutes. Are you able to hear me, Tahir?
Hi.
Yes, Tahir. Please take over. Are you able to hear me, Tahir? I would like you to take over and speak on the platform that and the platform features that Amana has to offer. Are you able to hear me? Um, Well, friends, I am sorry. I think we have lost Tahir. We are not able to connect with him. So I'll just finish on his behalf that Amana Capital is one of our preferred trading partners. So you have an option to explore the platform that is available from Amana Capital that offers extensively stable platform for CFD trading across all asset classes. So I apologize that we had a difficulty and we are still having it. So probably I'll not be able to bring Tahir on live in this session. So if you have any questions with regard to the platform, please also feel free to write to me and reach out on my email, which I'll be just sharing with you all. So now that brings me to the final takeaway. As a goodwill gesture, we are pleased to extend you a complimentary subscription to Gold Signals for 15 days. You will receive it on WhatsApp on the number that you have used for registering for this session. It will begin probably from day after tomorrow, and if you do not wish to receive it, just feel free to send a stop message on that number, and it will be stopped. But I would encourage you to please visit Amana Capital's website and of course the ChartWizard's website. Website is ChartWizard.ae, and you will find different products and services that we have for the traders as well as for the investors. So it's a complimentary gesture from us, and we are pleased to extend you this. And I would also like to now come to the questions part. If you have any question, I would be more than happy to take it. Yeah, we have a question that how come the gold and the US dollar prices um, are inversely related? The reason is that gold is denominated not only in US dollar but all currencies in the respective countries. And secondly, the most important thing is that the dollar price will increase if the interest rates rise, and if the interest rates rise, the returns in investing in the treasuries is much higher. Now people would resort to gold. The demand for gold will come only if the treasuries or the debt instruments are not offering strong interest rates, only if the economic cycle is little full of turbulence, if the equity markets is not doing good, if the outlook on the economy and the industrial growth is negative, all this will make the dollar weaker, and therefore will drive the demand to gold. So traditionally, gold and US dollar have remained inversely related. Any other question that we have? Great. So I would suggest all of you that if you have any questions, you may not have it now, but if you do have it after the session is over, please feel free to write to me at milan.v@chartwizard.ae with any question that you have, and I'll be more than happy to reply each one of you in detail to the extent possible. So this brings to an end of this session. I once again thank you on behalf of ChartWizard and on behalf of Amana Capital to all of you to have joined, spared your time and joined us. And we would look forward to connecting with you again. Thank you so much, everyone, for connecting. Thank you.